Hello everybody and welcome to this new video talking about 4 growth stocks that I've purchased this week and that I hope to continue purchasing next week. So the first of this stock is Enphase. So as you know, I love Enphase on this channel. It's my only tier 1 stocks along with Tesla, i.e. it's stocks that I have the most confidence in. And Enphase, you can see when you look at the stock chart, you're buying it as if 2.5 years didn't happen. Essentially, you're buying it just about the same price as you did in early 2021, late 2020. Again, I believe the drop in the stock price is very much unwarranted over the past 3 months. When I look at their sales figures, right, and you can actually calculate, they've done exactly 3 times their sales in 2 years. They have tripled their sales in 2 years. When I look at the stock price, flat. When I look at their performance, tripled. So it's very impressive. And the growth is not slowing down. Analysts, which tend to be conservative, I think for Enphase is going to be more than that, but analysts alone, they predict 43% revenue growth over the next 12 months. Their gross profit is 42%. I believe it's going to be much higher than that in 2023 because of the IRA. They have about $500 million of positive free cash flow, which gives them an enterprise value of 26 billion enterprise value over trailing 12 month free cash flow of 52 and PE of 42. I believe that these metrics are very low for a company growing at 43% going forward, and I think it will be more, but also with such a growth runway ahead of it. Solar panels on homes, we are nowhere near saturation, yet this is a technology that I think is just getting started. People are just catching on. People are just realizing the benefit of adding solar to your house. They're realizing in part in the US thanks to the $7,500 tax credit, which means that in the US, for most places, it's going to be between 5 years and 8 years payback on your installation, provided that you don't get quote-unquote ripped off by a contractor, because you always have to look out. There's always some scammy contractors, but typically if you get like 4 quotes, you're going to get an honest contractor which will give you an honest price. If you get an honest price, the payback on these installs is between 5 and 8 years. That is much better than, say, the NASDAQ, for example, and of course the S&P 500, and of course the money you save is not taxed again. You've already been taxed on the money you save. So it's equivalent to a tax-free return when you get solar. People are going to catch on this. I believe they'll already be catching on. I see it in my neighborhood all the time. More installs everywhere. Everywhere I go, there's more installs. Went to a trade show recently, a construction, a home show, home and garden show. Most of the installers were there. It's high demand. Solar is what? It's the cheapest source of energy. And it's now compelling everywhere for all family homes, I believe. I don't have enough time to develop on this, but it's clear. Batteries. We have something new with batteries. Batteries now have become so cheap that with a tax credit, you're about at a 5-year payback on a battery, or 8 years without the tax credit. And with NEM-free, a lot of states are pushing people to just install batteries. The subsidies. The Enphase not only benefits from the subsidies of people installing the product, right, the $7,500 tax credit that people get, but Enphase also get a direct subsidy for each inverter in manufacturers. And per my estimate, I've covered this in other videos, I think it's going to be about 80% of the cost of goods sold of these inverters is going to be covered by the IRA subsidies, which are stopping in the early 2030s. So there's a huge growth rate. Enphase is a near monopoly in the microinverter business. They are so large that they actually co-brand with large panel makers. So for example, SunPower has microinverters. They're made by Enphase. They're branded as SunPower. And a lot of the microinverters that you see in the market that do not have the Enphase brand on it are co-branded and actually made by Enphase. I believe microinverters are the superior technology, and they scale with solar adoption. One panel, one tiny microinverters. It's much quicker to scale when you manufacture a small component. The microinverter is much cheaper to scale, much easier to scale than you manufacture a solar panel itself. So I'm very bullish on Enphase. Let me move on to the next company that I'm bullish on, which is not tier 1, it's tier 2, but it's STNE, StoneCo. So that's my favorite Brazilian stock, actually. I guess you could say it's a tie with Mercado Libre, but at least my Brazilian exclusive stock is STNE. STNE is the square of Brazil. They have Square Terminal. There's 2 squares in Brazil, right? You have PagSeguro, which is also a competitor of STNE. But they are doing so well. And they also have a software business, what I call like a mini QuickBooks big business for Brazil. When you look at STNE, when you look at the stock, it is a forgotten company. They've had an issue in early 2021. The stock dropped earlier than a lot of the other companies in the market because they had an issue with their collateral system. They've posted losses, they've fixed the issue, they've moved on, but the market has entirely written them off, even though they've fixed that issue. Hypergrowth has resumed. As you can see here, during the issue it was flat, but it's resumed 2022, 2021. Up. Revenue is up in 2022, revenue is up 71% over 2021. So Mr. Market forgot about Stone. Analysts expects 39% revenue growth in 2023. I actually think that's low too. And it's a stock I cover quite a bit on the channel. Their free cash flow positive. Enterprise value is so cheap. Look at how cheap this stock is. Enterprise value over free cash flow is a 4.3. It's dirt cheap stock. The company also have a P ratio if you're into PEs. It's got a 24 PE and a 4 PE of 15, which is also cheap for a company which is expected to grow revenue at 39%. And I personally think it will be higher than that. But if you look at it in my spreadsheet, it is the cheapest stock in my universe. You are paying so little for that growth. Each percentage point of growth for STNE, you're paying little for it. In my view, this is a stock that's going to get re-rated at some point. And when it gets re-rated at some point and trades more in line with other stocks in its industry when the market notices, this stock will pay me a vacation someday in Brazil. At least I'm hoping, because it's a big position for me now. So I love StoneCo. Anyways, let me move on to Zscaler. So Zscaler, again, it's a tough company to discuss because it's more technical, but essentially Zscaler is the next phase beyond VPNs and firewalls. Zero Trust Exchange, I think, is where a lot of the cybersecurity technology is heading, where we have more and more tools into the cloud, and it makes less sense to connect to a company network to access those tools. It makes more sense to just secure every single connection independently, and that's what Zero Trust Exchange is. But if you dig deeper in the topic and try to wonder where the future is headed, I think Zero Trust is where it's headed. VPNs and firewalls, they're a thing of the past. They're still going to be there, but they're going to take a second role in cybersecurity. And therefore, when you look at Zscaler, it's tough to understand what's happened to the stock. It's a value stock at this point, in my view. Because if you look, the stock is trading at roughly the same price as 4 years ago. So roughly August 2019, it was roughly the same price. Take or leave, $10 was roughly the same price. Yet when you look at the revenue, you went from 300 million to 1.35 billion. So the revenue has exploded to the upside. You can see most quarters, 30, 40, 50% growth quarter over quarter. The revenue keeps growing, yet the stock has been flat. It's as if the market is not paying attention to a company like Zscaler, absolutely not paying attention. Analysts expect 44% of growth going forward. Gross margin forward should be 78%. It's very high. It's very good. Free cash flow is 480 million trailing 12 months. Enterprise value is $14 billion. They have more cash than debt, which gives it an enterprise value over trailing 12 months free cash flow of 29, which is low for cybersecurity. Cybersecurity is one of the more recession-proof businesses out there. That's the last thing people cut. That's the last thing companies will cut. You can see it's much much cheaper than the average in my universe. You're not paying up that much for that growth in that sector that is known, for recurring revenue. SaaS is recurring revenue. It's the best revenue you can get. It's safe revenue. You have customers and they spend more year after year. Anyways, I believe Zscaler, they're the pioneer in Zero Trust, but they also have the leading position in Zero Trust. They're the central player in the space. They're the main innovator. They deal over firewalls. I think they're the next stage in security over firewalls, like I've said. And yes, a lot of the reason why it's down is likely because we see layoffs everywhere. And so a lot of these SaaS stocks, including Zscaler, are seat-based SaaS. So of course, if you have less computers, less employees with their company computers, you're going to have less subscriptions to Zscaler. So it's a seat-based approach, and the market's like, oh, there's layoffs now. Oh, we're going to need less Zscaler, and boom, you bid the stock down. However, layoffs, like everything in most distributions, they happen at the edge, right? So companies still have to cover the bulk of their employees, unless companies are getting rid of every single one of their employee, which they're not. Every time these job cuts are like 5%, 7%, things like that. Like that's the hedge, right? So it may impact the growth rate momentarily, but Zscaler is going after installing Zero Trust on all of the computers in the organization, including the people who are not getting laid off. So I really don't buy too much that argument of the seat-based SaaS and there's layoffs when there's less need for Zscaler, because Zscaler is installed in companies that have already established employees that move on as they switch their laptops or as their IT gets updated. They move on to a better system of Zero Trust Exchange. So that's my take on Zscaler. And then the last one, and I have to talk about this one. I know. I've received a comment. Everybody talks about Tesla. Stop covering Tesla. Well, yes, everybody talks about Tesla, but everybody talks about Tesla probably for a reason. I made a video about the wisdom of the crowd. If you remember Apple, in the early days, I remember 2011, 2012, everybody was talking about Apple. They could not shut up about Apple, and Apple turned out to be one of the best investments you could have made if you bought Apple in 2011. And same for Nvidia. Like I could make the same argument for Nvidia. Nvidia was very popular in 2015, 2016. I remember all of these YouTubers only on Nvidia. There is something to be said about the wisdom of the crowd, although I don't look at that too much. My assessment of these companies is only thinking from scratch. That's my view. I always try to think from scratch and forget about any preconceived assumption. It's hard to do. I don't pretend to do it well all the time, but it's nonetheless something you try. If you look at the Tesla chart, let me just comment quickly before I go into the company briefly. If you look at the Tesla chart, it's and you don't understand log scales, it's easy to think it's speculation. Like you look at that chart and you're like, what's going on? It's 2020, and then boom, it just shot up. And it's easy to dismiss it, but you would forget that it's not the first time the stock of Tesla has shot up. Actually, Tesla shot up in around 2013. They had an equivalent multiple X up in 2013. And so when you use a log scale to visualize the Tesla stock, it's much less a vertiginous spike. The spike is way less vertiginous. I haven't ran the log until today, but you'd see it be probably around here today in the chart here. The point is, this is a company that is well over 150x times your money since IPO. Obviously, you're not gonna get another 150x, but in my view, at least a 10x by 2030, in my view, would be a conservative estimate. That would be conservative by 2030, or 10x in my view, which for the size of this company, this company is de-risked now. This company has way less risk given the size that it has reached. So you always have to do like the risk adjustment calculation in your mind, because if you had bought Tesla in 2011, 2012, that was insane risk. For example, I own OpenDoor. I am sure the way I feel about my OpenDoor stock is very similar to the way people felt about their Tesla stock back in the early days. and in the volatility. And that's just the nature of the beast. It's just the way it is. Let me briefly talk about Tesla, why I believe Tesla will be adopted. Of course, most people who talk about Tesla talk about this part here, which is the auto business. But let's remember that it's a much bigger conglomerate than just the auto business. First of all, they are the leading charging network around the world, and you have to ask yourself, is Tesla going to be quote unquote the new Standard Oil at some point? Are they going to be Chevron, Exxon, Shell, major companies? Shell was never part of Standard Oil, but at least Exxon and Chevron combined. Like, could they be Exxon and Chevron combined in the future network of convenience stores and charging? I believe that is a fair possibility as people switch to electric cars. Now they're opening up the chargers to anybody outside of Tesla, right? Any other electric car can now use their charger network. That's a big opportunity that is not discussed too much, mostly because gas stations aren't really sexy. Like, who cares about gas stations? But it's a big part of their business. Modern day gas station, the modern day electric gas station. Another one which again I refrain of talking about too much is the AI business. And whenever you start talking about the AI business for Tesla, people are like, "You're crazy. Tesla is not an AI business." Well, it actually is. Let's not forget that who founded OpenAI? OpenAI, the founder of ChatGPT, right? You have all heard of ChatGPT. Who founded that? Well, it's Elon Musk, who, with other members of the PayPal mafia, founded OpenAI. So I believe Tesla is an AI company. And I remember one of the early videos I made on the channel was Elon discussing AI. And he was comparing the skills of AI at Tesla to the skills of NVIDIA. He was comparing the skills of their computers to the scale of NVIDIA, to the computers they're developing. So I think it's important to place where Tesla is. And so what they do with FSDs is extremely impressive, even though, of course, right now, in the business, it doesn't show too much into the numbers because the take rate of FSD is not very high, because a lot of people still don't want to drop $15,000 to have FSD. Nonetheless, it's a big part of the business. Now, of course, the main part of the business is the auto business. It's the whole idea of why are Teslas going to be adopted. And here, depending on what you look at, feel free to stop the video, you're at within one order or two orders of magnitude better. So for example, when you pay $7 for a charge versus $70 for a gallon for a tank of gas, that's a 10x improvement. And what do we know from books like 0 to 1 from Peter Thiel, right? Peter Thiel, friend of Elon Musk, PayPal founder along Elon Musk, same PayPal mafia, quote unquote. What you know is that when you have a product that's an order of magnitude better, people flock to it. It just gets adopted. It gets adopted without advertising, without anything, because people catch on. People notice that it's significantly cheaper, right? When Tesla is releasing the $30 a month for unlimited charging of your Tesla at night here in Texas, $30 a month, people notice that. People are like, well, wait a minute. I have my budget. I spend $4,000 a year on gas, $4,000 a year of gas. That's not uncommon. All of a sudden, I switch to a Tesla. I'm spending $30 a month, right? Spending $360 a year. So in that case, that's more like a 20x improvement. And you can go on and go on and go on. But or in the early days of Tesla, they had the 1,000,000-mile warranty. Nowadays, reasonably, you can expect a Tesla to last between, I would argue, 400 to 500 miles. That's still a doubling compared to what it was. They have 10x fewer moving parts, less maintenance, etc., etc. And then you have also hedonic adjustments, right? But what I would argue more hedonic, i.e. they're more pleasant. And so there are things that are more pleasant that are hard to quantify with numbers, or at least with 10x numbers. But not having to go to the gas station, it's pleasant to not go to the gas station. Buying online, it is pleasant to buy a car online. I do not know anybody who thinks haggling with a dealer on a dealer parking lot is a pleasant experience. So there's all of these hedonic adjustments which make the product better and that are hard to quantify from a 0 to 1 standpoint. Anyways, that's just for the auto business, right? There's more than that. There's the semi business, which could in its own right be a major near monopoly of a transportation market, right? Then you have a parallel business. So Tesla's not doing too well with the microinverters or with the solar panel business. That's kind of a side business that they forgot about, in my view. But there was no denying that in the battery, in the home battery, in the single family house battery world, right? They are a major competitor to Enphase and to anybody selling a battery. Now it's competitor, quote unquote, co-competitor as well, because you can totally have Enphase microinverters and then decide to have a Powerwall. Like all of these setups combine with each other, or you can have another brand like a Franklin. That makes sense. Like it's not entirely head-to-head competition. There is some compatibility, but nonetheless, Tesla has a significant business with a parallel business, and you get that for free because the valuation currently does not even represent the auto thing. And then the Megapack business, which the Megapack business is, I believe, could be just about as big, maybe not as big, but maybe 70-80% of the auto business. And they are the absolute leader in the Megapack business, actually. As I was researching STEM, I found out that STEM is still the leading buyer of Megapacks. Tesla is a leading supplier of Megapacks to STEM. The Megapack has the leading position in that market, and they pretty much invented that market, and so that's an extremely promising business. So, yes, everybody talks about Tesla, but I believe it's for a reason. Yes, the claims seem exaggerated, and in fact, I got to understanding Tesla fairly late, I would argue, because the claims have always seemed exaggerated, and they still seem exaggerated. And when you hear Elon Musk say very seriously on multiple calls over and over again, Tesla will grow at 50% a year, each year, until the end of the decade. Speaking of the auto business, we know the famous target of Tesla is 20 million cars by 2030. Per my calculations, it is more than possible. In fact, when I look at the cars, I get at 22 million by 2030. But you have to think exponentially, right? You can't think linearly. If you think linearly, you're not going to get there. And this is based on this guidance. This is kind of my calculation that I have here, which is Tesla would get almost 1.4 trillion. It boggles the mind to even think that. I mean, that would be like 3 apples in terms of sales. $1.4 trillion in sales in 2029. It makes sense, though. You're selling a car. You're not selling a $1,000 phone. You're selling a car that's worth many phones. And so if you were to assume that and assume a compression in the price to sales ratio, I get to essentially a 12x from here. And then if you assume the price sales ratio is the same, I get to a 17x. And if you assume price to sales ratio expansion, which is realistic given the fact that historically Tesla has traded at a much higher rate, you would be at a mind-blowingly ridiculous 24 times your money. So these numbers don't make sense. I think these numbers are not going to make sense for a decade. I think anybody who looks at Tesla with a classic lens of finance is not going to understand this company for a decade. And so I'd rather be part of people who maybe don't understand it entirely fully, but I think I do understand it quite a bit. But that makes sense. Like it's like staying. Yeah. Anyways, I'm very bullish on Tesla. It's my most bullish position. And we're still in the phase where you meet on a daily basis a person who mocks electric car. This is still that phase, or at least in the US. You're always gonna find a lot of people who mock them. We're still in that phase, but in my view, and this is based on my facts and my research, EVs, they're the smartphone on wheels. They're gonna follow a similar adoption curve, and a lot of the cynicism that I see against electric cars today, which is still present, although less and less. It's gone down over the past 2 years, I would argue. But that cynicism is the same cynicism of, if you may not be old enough, it depends on how old you are, but you may remember BlackBerry versus Apple. When Apple iPhone came out, it was obvious to absolutely everybody that BlackBerry was going to kill iPhone. So much so that they produced this commercial with a BlackBerry shot at the Apple. All right. Anyways, and we all know what happened, right? We all know that BlackBerry, which were beloved by everybody, which were shown as status symbol, got crushed by Apple. And this is because old tech, i.e., tech that is orders of magnitude inferior. When a tech is 1 or 2 orders of magnitude inferior, that old tech loses. The horse lost to the steam engine, and the steam engine lost to the gas engine, and the gas engine is going to lose to the electric engine. Anyways, and you know, people still love horses. I live in Texas. They love horses in Texas. People still love horses. You're still going to have people that love gas cars, but it's not going to be your daily. It's not going to be your daily because when it's so inexpensive to drive an electric car, you know, right? Who owns horses today? Most people who own horses are you know, wealthier people, right? That's I think that's going to take the same thing for gas cars. People were obsessed with BlackBerries when the iPhone came out. It was obvious to everybody that iPhone was not going to make it, and iPhone crushed BlackBerry. The rest is history. I believe the whole Tesla and electric cars in general versus legacy ICE, i.e. gas cars, I believe is going to follow the same trend, at least over the next 10 years, and I am excited. I can't wait to see how well Tesla does. It's a stock that I will not sell, and even if it gets to silly proportions in the portfolio, it's a stock that you don't sell a winner. You don't sell a winner like that, at least. Anyways, thank you for watching. This is not investment advice. This is just entertainment. Thank you. Please like, please subscribe, and have a wonderful day.